All right, so we start with Unit 1, an overview of the South African macroeconomic environment. This is 2602, which is macroeconomics. Just very quickly, the difference between macro and micro. Because it's macroeconomics, you're looking at variables that affect the economy as a whole, whereas in microeconomics, we're looking at just the behavior and decisions of individual consumers, households, firms, etc. But like I said, macroeconomics deals with the economy as a whole. It explores the relationship between aggregate concepts. Aggregate means total, such as income, production, price level, interest rate levels, etc., etc. So we're dealing with variables that affect the economy as a whole. Now, the first thing that we're going to do is differentiate, or rather go over some important concepts. You need to know your definition of GDP, gross domestic product, total value of all final goods and services produced within the boundaries of a country in a particular period. So you need to remember your definition of GDP. And a couple of different things about GDP. When we deal with GDP, gross domestic product includes the total amount of goods and services produced. That is, no adjustment has been made for depreciation. So when we talk about GDP, we're talking about final goods and services. Final goods and services are those goods and services sold by the retailers to final consumers. All right? The difference between a final good and an intermediate good: a final good is sold to the end user, and intermediate good is sold, or rather used in the production of a final good. All right? So, for example, when a baker buys flour, the flour would be an intermediate product because flour is used in the production of bread, which is the final good sold to the end user. All right, so intermediate goods used in the production of other products, okay, and are excluded to avoid double counting. So when we're calculating GDP, the reason we say it's the final value of goods and services, if we count the intermediate products and the final products towards our GDP, we will overestimate the value of our GDP. All right, so essentially you just need to calculate the good once. If you calculated the flour that is bought by the baker, and then you calculated that flour again that is contained in the bread bought by the final consumer, essentially what we've done is we've counted that flour twice, and it will overestimate the value of our GDP. Right? Total value is the value of production in terms of prices of the various final goods and services. And when we talk about GDP, we're talking about current production. So it's only the production of new goods and services that are produced in the current year. So if, for example, you purchase a car this year and you sell it next year, that car will only count towards your GDP or your country's GDP this year, and not when you resell it next year, because it's already been counted towards the production in the previous year. Nominal versus real concepts. The equation that you need to remember for that is real is equal to nominal minus inflation. Right, now what that means is real variables have taken inflation into account. Nominal variables include or have not taken inflation into account. Right, we'll go over that in much greater detail later on. Nominal is also another word for current, and real is constant. So you need to remember that as well. When we talk about constant prices, we're talking about real prices. And when we're talking about current prices, we're talking about nominal prices. All right, so nominal GDP is the sum of the quantities of final goods and services produced multiplied by their current price, their market price. An increase in nominal GDP might increase over time as a result of either the quantity of goods and services produced or just the prices of those goods and services produced. So if we look at an example, the reason we differentiate between nominal and GDP. Let's assume we've got one factory in the economy. They produce one product, which, for example, would be bicycles. So they produce bicycles, and they sell these bicycles for 10 Rand each. Right? If they produce 10 bicycles, right, and they sell each bicycle for 10 Rand, the value of GDP within this economy would be 100. It is the amount of product produced multiplied by the retail price, which is 10. So 10 times 10 is 100. Let's assume that is for the year 2010. Okay, so in the year 2010, 10 bicycles produced, sold for 10 Rand. The GDP in this country would be 100 Rand. Now, let's assume the next year, the following year, in 2011, the owner of this factory still only produced 10 bicycles, but he increased the price from 10 Rand to 15 Rand. In this case, or in this year, if we calculate a GDP, we would get a total value of 150 Rand for this economy. But now, he's still only producing 10 bicycles in year 1 and year 2. So he has not employed any new additional workers. He has not bought any capital equipment. He has not increased the amount of resources that he purchases to produce these bicycles. He has not actually grown the economy in any way. The only reason that we have an increase in our GDP is due to the increase in price. So there's no real growth behind this increase in GDP. This would be nominal GDP. Now, if you wanted to calculate your real GDP in year 2011, what you would do is you would take your quantity in year 2011 and you would multiply it by your price in year 2010 to get, or rather your base price, to get your real GDP. All right? So real GDP is the quantity in the latest year multiplied by the price in the base year. Real GDP at constant prices are quantities produced and valued at their prices in the base year. It overcomes the problem of price changes. Real GDP therefore measures the actual physical volume of production. Per capita, real GDP, any per capita variable that you are looking at, per capita means divided by the population. So if you're looking at real GDP per capita, it means we're taking the real GDP and dividing it by the population. Nominal GDP per capita would be nominal GDP divided by the population. So just remember that per capita means divided by the population. Some problems with using GDP as an economic indicator for the well-being of a country. Firstly, measurement problems. If a factor such as an increase in defense expenditure was responsible for the increase in GDP, it does not necessarily follow that there was a related increase in economic welfare. So for example, when the government spends money on a warship or an aeroplane for 200 million Rand, yes, our GDP increases by 200 million Rand, but the economy or the citizens of the country are no better off because of that increase in GDP. Secondly, the distribution of income. An unequal distribution of income implies that the benefits of an increase in GDP flow largely to a relatively small group of people and do not trickle down. So very much similar to the same, or very much in the same way that point number one does not make the general consumer better off. Even if the GDP does make a few people better off, it will not make the majority of the economy better off. So we're going to look at what we call our macroeconomic objectives. Now you should remember this from ECOS 1. South Africa has 5 macroeconomic objectives. Now these macroeconomic objectives are indicators for how well the economy is actually doing, for how well South Africa is actually doing. All right, so the first one that we look at is economic growth. Now when we talk about economic growth, essentially what we are looking at is the change in real GDP from year to year. All right, so as I indicated, nominal GDP does not necessarily indicate if the economy is growing or not, because an increase in nominal GDP might be attributed to an increase in price. So we instead look at the real GDP and rather the change in real GDP. We want to see the percentage change in real GDP from one year to the next to determine if there is economic growth in South Africa. All right. Now, this economic growth does not take place smoothly over time. So we examine the different business cycles, or rather business cycles, and we look at economic growth in this case. Economic growth follows somewhat of a wavy trend, but hopefully over time there is a long-term upward trend line that it follows. So you need to know the different points on this business cycle. What they might do in the exam is they'll give you this business cycle and they'll ask you to label the different points. At the top of a business cycle, or rather at the turning point, you've got what we call the peak, and follows a contraction until we reach a trough, which is the bottom turning point. And as the economy hits this turning point and turns around and starts expanding again, that is the expansion path until we reach the peak. All right, so some things you need to remember for your business cycle. To measure a cycle, it needs to be between two consecutive points. So between a peak and a peak, or a trough and a trough. You need to measure the complete business cycle. So because of these business cycles, because economic growth does not take place smoothly over time, it follows a series of upswings and downswings. As you can imagine, during the downswings, unemployment increases, production slows down, and this is bad for the economy. So we've got two different policies that we use to intervene in the market, to intervene in the economy, to try and prevent these downswings. Now, the first one is what we call the fiscal policy. Now, the fiscal policy is the government's policy. The South African government has what we call the fiscal policy, and the fiscal policy is made up of government expenditure and taxation. The main policy variables: government expenditure and taxation. So to define fiscal policy, it's the government's policy in respect of the nature, level, and composition of government spending, taxation, and borrowing aimed at pursuing particular economic goals. You don't have to remember the definition word for word, but you do have to understand and know what the fiscal policy is and how it would be implemented in different phases of the business cycle. So the first one, expansionary fiscal policy. Expansionary fiscal policy is used to boost economic activity. All right? So in order to boost economic activity, we need to increase government expenditure and or decrease tax. Essentially what we're doing is, when the economy is in a contraction or a downswing, the government wants to spend more money into the economy, driving up income, production, and spending within the economy to stimulate the economy. They can do this through government expenditure and or the decrease in tax. If government decreases tax, people have a higher disposable income. Disposable income is your total income less the amount of tax that you pay. Your disposable income is the income that you have available to spend, to dispose of. So if the government decreases tax and disposable income increases, it can also stimulate spending because people have more money available to spend. So if they increase the amount of spending, either by increasing government expenditure or decreasing tax, or both, spending will increase. As people spend money on goods and services, the demand for these goods and services increases, and production will have to increase. Our producers will notice that their inventory levels are decreasing, and they will have to increase the production. In order to do so, they will have to employ people. Employment will increase, which will further increase income and demand for goods and services, and we will have, hopefully, an upswing in the economy. All right? This is called a demand management policy. Now, it is the main element of demand management or stabilization. So, both monetary and fiscal policy are what we call demand management policies. Now, as I explained to you, when the government increases their spending or decreases tax, they stimulate demand for goods and services. The fiscal policy affects the economy from the demand side. It increases the demand for goods and services, and it therefore increases the production of goods and services. But it is done through the demand side of the economy. Now, the monetary policy is the other macroeconomic policy that we deal with, and the monetary policy is the South African Reserve Bank's policy. All right? So to define it, the monetary policy involves all the deliberate actions by the monetary authorities. In South Africa, the monetary authority is the Reserve Bank, the South African Reserve Bank, to influence the monetary aggregates and availability of credit, interest rate, and exchange rates, with a view to achieving economic growth, full employment, and macroeconomic stability. So there's a couple of more objectives of the monetary policy. Their objectives are exchange rates and economic growth, full employment, and macroeconomic stability. Now, the main instrument of the monetary policy is what we call open market operations. Now, open market operations is the deliberate buying or selling of financial instruments by the central bank to either inject or extract money from our economy. So think about it. When you walk into a retail shop, if you purchase a product, you hand them your money, they give you the product. Their amount of product is decreasing, but in their cash register, the amount of money is increasing. And it works the same with the economy. You've got to view the South African Reserve Bank as an external entity, actually both the South African Reserve Bank and the government, as external entities from our economy. So you've got the SARB and our economy. When they sell financial instruments, all right, when they sell financial instruments, they're giving the economy the financial instrument, and we're giving them a bunch of money. So when they sell financial instruments, they are decreasing the money supply. If, on the other hand, they buy financial instruments, the financial instruments are leaving our economy, but money is entering our economy, the money supply will increase. So, South African Reserve Bank can influence the amount of money available in our economy. They can either increase or decrease the money supply. The government operates in much the same way. So the government, when they spend money into our economy, government expenditure, the money supply increases. And when they tax us, the money supply decreases. All right, now, from empirical data, we can see that when the money supply in a country increases, there is generally an increase in economic activity, but it also stimulates inflation. So there is not a one-for-one relationship. Increasing the money supply will not necessarily increase the economic activity. It might just cause inflation, but there will be, or based on empirical data, there might be some increase in economic activity. All right. So the main policy variables are money supply and the interest rates. We'll get to those later on as well in the unit or in the module. An expansionary monetary policy is the increase in money supply and the decrease in interest rates. And a contractionary monetary policy is a decrease in the money supply and an increase in the interest rates. All right? Now, they can't use both of these variables. They need to only use one of them, which we will see in the financial market later on. But if the South African Reserve Bank decides to target the money supply, they cannot target the interest rate and vice versa. They cannot target both of these variables. They can only target one of them. The effects of interest on investment spending are the focus of monetary policy in this module. So you need to remember that there is an inverse relationship between interest rate and investment spending. If interest rate increases, investment spending decreases, and if interest rate decreases, investment spending increases. Inverse relationship, which you need to know. The next macroeconomic objective that we look at is our inflation. All right, so you need to know the definition of inflation, which you should remember from ECOS 1. Continuous and considerable rise in the general price level. So it's continuous, it's an ongoing increase in prices, it's considerable, meaning that it approaches or breaches our target. Now, the target in South Africa for inflation rate is between 3 and 6% per annum, all right? And it is in the general price level, not only for a specific price. So it's got to be prices in general that affect the general consumer, all right? The indicator that we use to calculate our inflation rate is the CPI, the Consumer Price Index. And remember, to calculate the rate of change of any variable, the equation that you need to use is new minus the old divided by the old times 100. That will give you the rate of change between any two variables. All right? The CPI, the Consumer Price Index, reflects the cost of a representative basket of consumer goods and services. The rate of change in CPI is used to measure the inflation rate. The third one that we look at is our unemployment. Pretty straightforward. You know what unemployment is. Firstly, you need to know the two definitions of employment. We use what we call the strict and expanded definition. All right? An unemployed person is someone who is willing and able to work but who does not have a job. All right? The strict definition used by Stats SA needs to include 3 different points. All right? So, unemployed are those who are being 15 years and older, are not in paid employment, were available for paid employment or self-employment during the 7 days preceding the interview, and took specific steps during 4 weeks preceding the interview to find some sort of employment. Now, when we talk about the interview, essentially how we calculate unemployment in South Africa is we send out a questionnaire, a census. So it will go out to a certain amount of people within the country, and they will fill this questionnaire in, and then once we get the stats from that questionnaire, we simply extrapolate that percentage or those stats for the entire economy. So for example, if 50,000 questionnaires go out, and of those 50,000 questionnaires that were completed, 10% of the population is unemployed, we will just assume that 10% of the entire economy's population is unemployed. So that is the interview they are talking about. The expanded definition omits the requirement that a person actively seeks employment. So expanded definition would include what we call discouraged workers. So they are unemployed, but they are not actively seeking employment. They are discouraged workers, and the expanded definition includes this amount of people. All right? So your expanded definition is always larger than your strict definition. Now, you need to know how to calculate your unemployment rates. Your unemployment rate is the number of unemployed people as a percentage of the economically active population. Unemployment rate is equal to the unemployed divided by the unemployed plus your employed. Your economically active population is also called your labor force, and it is made up of unemployed plus employed people. The type of unemployment that we face in South Africa is structural unemployment. Now, there's 4 different types of unemployment that we look at, and South Africa suffers from what we call structural unemployment. This is when there is a mismatch between workers' qualifications and job requirements, or when jobs disappear because of structural changes in the economy. So, for example, when we built the Gautrain, we had to bring in engineers from other countries. We did not have the skills available to fill the jobs. Now, structural unemployment can only be solved by education. Essentially what it means is that we do not have the skills or education available in our country to solve our unemployment. If we simply use monetary and fiscal policy to increase the amount of jobs available in our country, we will not have the skills or skill sets to fill those jobs. The 4th macroeconomic objective is our balance of payments stability. Now, the balance of payments is the account that records all transactions of South Africa with the rest of the world, with the foreign sector. You need to remember your definition and some of the sub-accounts that we look at, the most important being the current account and the financial account. Now, these are the 2 most important sub-accounts of our balance of payments. The current account measures our imports and exports of goods and services, and the financial account measures our inflows and outflows of capital either into or out of South Africa. The capital transfer account is simply when, for example, you've got foreigners working in South Africa and they send money home, or you've got South Africans working overseas and they send money back into South Africa. That is a capital transfer account. Unrecorded transactions is simply a balancing item, because obviously the balance of payments is an account that needs to balance, and it doesn't always do so. We use the unrecorded transactions to balance this account. The final macroeconomic objective that we look at is the distribution of income. Now, obviously, we would like to close the gap between the ultra-rich and the ultra-poor in South Africa. We would like a large middle-class type of population where a high majority, a high percentage of the people have access to medical, to schooling, to education, whatever the case is, to food and shelter. All right? Distribution of income. We have the most one of the most unequal distributions of personal income in the world, and it is indicated by the Gini coefficient, which you will see later on in our labor market. And that is it for study unit 1.